The journey of the organization has witnessed great transformation as to the changing needs of the industry and businesses. The Federation of Telangana Chambers of Commerce and Industry, FTCCI, legacy of excellence, voice of the industry, representing interests of over 25,000 businesses of all sizes, sectors, and regions in the empowering industry and trade of Telangana state. The leader in the global vaccine, home to all major MNCs, leader in the exports. India. FTCCI advocates of the business environment caters to the needs of MSMEs, foreign entrepreneurs, and traders through its advisory services in taxation, information, industry-related issues, B2B connection. The Chamber has its nominees in the state-level advisory committee to help business productivity. FTCCI aims in providing certificate of origin for exporters, issues visa recommendation for business travels, evaluation in job skills to the dedicated skill center. It has adopted 14 government ITIs to improve the employability of students. With a uniquely global perspective, the FTCCI events reach a highly engaged audience, policymakers, and stakeholders aiming towards with the power. This academic and proactive innovation together is the future.
I now request Shri R. Ravikumar Sir, President of FTCCI, to give the welcome address.
Once again, good morning to everyone. And I run a company, so I know the problems of these taxes and things like that. How much ever the owners of companies are educated, I might be wrong, but I'm very honestly confessing. We end up, the moment we think of GST or income tax or any tax, suddenly we get into a different mode and we feel something is happening. Incidentally, 2 days back, I was with few chartered accountants. We were in that MSME office discussing about the latest things. So the chartered accountants also were confessing, saying that the changes are happening on almost on daily basis or weekly basis. So they are saying we need to upgrade ourselves almost on daily basis. So in this context, I think our chair, Naresh Chandragelli, who has organized this event, it is wonderful that such events should happen. And our film of FTCCI speaks about it. We are pro-industry and we want to help people. And such events, I think we should have. And it gives me immense pleasure to welcome you all for this webinar on tax audit compliance under the Income Tax Act. And I especially extend my warm welcome to each one of you. And also our session speaker, Sri C.A.K. Gururaj Acharya. So nice of him for accepting this and coming. And he's joining from Bangalore, if I'm right. Yeah. And all the distinguished delegates also. As we all know, tax audit is a critical area in the Indian tax framework governed by Section 44AB of Income Tax Act 1961. With constant amendments, evolving interpretations, and the growing importance of accurate compliance, it becomes essential for professionals to stay updated and aligned with the latest developments. With stricter scrutiny and increased reliance on technology by the Income Tax Department, even minor lapses in tax audit reports can lead to serious consequences for both client and auditors. Hence, this platform is not just a learning opportunity, but a professional necessity. We are honored to have with us today Sri Guru Raj Acharya, who brings with them a wealth of experience and deep expertise in tax, laws, and audit practices. Their guidance and insights will no doubt be invaluable to all of us. Very valuable it will be. Before we begin, I would like to thank everyone who made this webinar possible. I encourage all participants to actively engage, ask questions, and make the most of this opportunity to clarify doubts and strengthen your understanding of tax audit compliances. Thank you and have an impactful session. Thank you once again.
Thank you, sir, for starting the program. I now request Sri Naresh Chandra Geli, sir, Chairman of Direct Taxes Committee, FTCCI, to give the introductory remark.
Good morning to all the delegates who have registered from across South India, who are more than 300 registered for this program. And my welcome to the speaker, Guru Raj Acharya, who is a very senior, seasoned professional and is been speaker on direct taxes in the CA Institute across South India. And we are very glad that this year, the Direct Tax Committee of Chamber of Commerce is starting our first program through his address on this topic of tax audit compliance under the Income Tax Act. Welcome to you, sir. Friends, it's my pleasure to welcome each one of you for this. And the tax audit under 44AB plays a crucial role for ensuring transparency, accuracy, accountability in financial reporting, and which is our role as a chartered accountant. And we also welcome all the business community people, business owners who are participating in this event. In recent years, in evolving, the department has been evolving the formats, enhancing disclosure requirements, and greater regulatory scrutiny has been made it essential for all of us to stay well informed and compliant. As our president mentioned rightly, the changes are so fast and so regular that all of us, however senior we are, we need to be updated and stay informed. This session aims to address recent developments, clarify key reporting requirements, and highlight common challenges and best practices in tax audit compliance. We are fortunate to have Sri Guru Raj Acharya as our speaker, who will be sharing his valuable insights and practical guide. I encourage everyone to participate actively, ask questions, and share your views. I request all the participants to please raise your questions in the Q&A chat so that it will be easy for all of us to go through, and also for the speaker to identify the important questions and answer at his convenience, and make the most of the learning of this opportunity. I welcome each one of you and look forward for a productive session ahead. Thank you.
Thank you, sir, for laying the foundation for the program. I now request Sri Ramdev, sir, co-chair of Direct Taxes Committee, to introduce today's session speaker. Sir, over to you.
Thank you, madam. Good morning to all. Respected President FTCCI, Chairman Sri Naresh Geli, to have Sri Guru Raj Acharya Garu. Guru Raj Acharya is a senior member of the institute, having vast knowledge and experience in the field of accounting standards, company law, auditing and assurance standards. He is senior partner of KG Acharya and Company, Chartered Accountants, Bangalore, and also a director on the board of Karnataka Bank, and also holding very responsible position as chairman of Audit Committee. I know very key position is holding as chairman Audit Committee, because I am also connected to one of the bank. That's why I know importance of it. And also he is a expert. He was a co-opted member of Expert Advisory Committee on Accounting Standards for local bodies by ICA New Delhi, and also member in Bangalore Bangalore local body for financial review reporting, and also a group formed there for review of financial statements. He is also a member of that. And he also, not only that, he is served as a member of various forums, but also he authored a book titled as Internal Financial Control, which is a practical handbook on audit report on what can go wrong. I think it will be very helpful for all the persons who are subjected to audit and
Thank you, sir, for the introduction. I now request our speaker, Shri Gururaj Acharya, sir, to take over the session. Sir, over to you.
Thank you, Naresh Gilligaru. I hope I am audible because Ramdev
Yes,
Bhutta, when he was speaking, it was slightly breaking. I believe
Yeah.
my voice and video is better than what it was. So first of all, thank you, Naresh Gilligaru, for inviting me from the land of Kantara to the land of Pushpa now. I think that's a better way of putting it because Kantara is doing great news in Bangalore and of course all over South India, just like what Pushpa did in your, the contribution that way. So I think, and again, I thank the President, Mr. Ravi Kumar, for giving the opening remarks and telling the importance of such sessions and also saying that this session should be impactful. I really like the word impactful, sir, because that is what is very important. A session of 1.5 hours, if it is not impactful, I think people just waste their time. I think we should make it as impactful and like what Mr. Naresh Gilli said, productive. I think I catch these two words and get from there. I believe somebody is saying volume is very low. I don't know whether it is my volume. As long as you are saying it is good, I believe Suhas is saying that volume is, I think, Suhas, you please increase your volume. So the session will be 1 hour and 15 minutes from my side, and then any number of questions can come through. But at the same time, maybe if there are any questions that you want to pose, you can always put it through. You can always put it in the question and answer box, and then I will request Mr. Naresh Gelli to moderate or Mr. Hanmadlu to talk about raise these questions. Okay, so I will. I mean, very interesting point is we are in the verge of shifting from 1961 Act to 2025 Act. I am making a very conscious statement that I will be talking about the 1961 Act. So therefore, I will be talking about 44AB and not about Section 63. I mean, just for the information of all of the people, what is the Income Tax Act 2025? Today, I'm very happy to see Naresh Gelligaru without a coat. The difference between the 1961 Act and 2025 Act is that from the 1961 Act, they have removed the coat. The person is the same. So they have removed the unnecessary fringes, which are the tie, the coat. I mean, I would have also preferred not to wear this half sleeve, but I knew that the president would come that way and I never wanted to displease him. So I thought I will be in the same attire as that of the president. But otherwise, the 1961 Act had too much of weight built into it. So therefore, they put the 1961 Act on a treadmill, and after running for about 1 year, it has become a 2025 Act, leaner and slimmer in that particular sense. But the content is going to be the same. For the benefit of Ravi Kumar Garu, there will be no change in the tax that you're going to pay from the 1961 Act to the 2025 Act. So that is the assurance that the finance minister said, and I have gone through in detail, and I stand by her assurance. So it is going to be a big challenge to the chartered accountants in particular that we will have to rewire the entire learning, the entire section itself, what was there. We were so familiar with so many sections like 44AB, 269SS, 40A, 1A, 43B, these are all built into our blood. So all these will have to be renamed and rechristened. So that will be a biggest challenge. Otherwise, there is no change. So that is the starting with which I want to start off. And now I will put up my presentation to make the session more impactful in that sense. Although I can talk like without the presentation, but to make it more impactful, is the presentation visible, sir, on the screen?
Yeah, very much.
Yeah. So I think you have put up a very good, what should I say, a flyer, and immediately after the flyer, I broke down the flyer into what is the menu for the day. So I'll be talking about the tax audit compliance. To make it very clear, I said under the Income Tax Act, there could be various tax audits. It could be a GST audit, or under the Income Tax Act itself, we will have so many audits. One of them is the audit under section 12AB required for the trusts, which I am not talking about today. I am talking about the tax audit under section 44AB, which is leading to a form 3CD, which needs to be filled up by the chartered accountant. So the legal provisions, the roles and responsibility of the auditor, the common audit errors, the recent amendment, there has been a change in the format of the 3CD. We will be talking about the practical compliance challenges, the key judicial rulings, and I think the person who introduced me, Mr. Ramdevji, thanks for the introduction. You wanted me to talk about the changes in the accounting standards and the formats of the financial statements for non-corporate entities. So this will be the menu for the day. So let me start off. Where is tax audit not required? Now, where is tax audit not required? If I know, then I will know for all other cases tax audit where it is required. So tax audit is not required if anybody's turnover is less than 1 crore. If the turnover is less than 1 crore, tax audit is not a must. However, there has been, this is told in section 44AB. If you go to the fourth line, if you're doing a business, Kumar Garu, I'm sure you're a businessman, you said, if your turnover is less than 1 crore, you don't have to subject yourself to tax audit. However, the government gave a further relaxation in the fourth bullet point. It is there saying that if your turnover is less than 10 crores also, you don't have to subject yourself to tax audit, provided both sides of your cash book, both sides of your receipts and payments are less than 5% in cash. Both sides of your receipts and payments are less than 5% in cash, then up to 10 crores. Most of the software industries, most of the professional organizations which do not deal with cash, or they deal with cash of less than 10%, less than 5%, both sides, left side, that is the receipt side, and the right side, which is the payment side of the inward and outward. If less than 5% is in cash, then I don't have to pay. I don't have to subject myself to tax audit up to 10 crores. However, there is one very interesting thing which is told in the presumptive taxation. In the presumptive taxation, what is told is even if your turnover is up to 2 crores, you don't have to get yourself subjected to tax audit, provided you are an eligible assessee. Who is an eligible assessee? An individual, a HUF, or a partnership firm. These are three persons considered as individual eligible assessees. So if their turnover is up to 2 crores and they opt for presumptive taxation, what is the option? If they opt for presumptive taxation, they should show a minimum of 8% of their receipts as the total income, 8% of their receipts as total income. However, there is an exception to this rule, which is 6% of their total income, which is derived in eligible modes. If the amounts are received in eligible modes, or I would say prescribed modes means account pay check, account pay draft, electronic clearing system, and 8 other modes as told in Rule 6 ABBA. There are 8 modes which are told in Rule 6 ABBA, which starts off with the NEFT, electronic transfer, BEAM, then I'll say BEAM, Arjun, Nakul, Sahadev. I mean, there are prescribed modes, 8 other modes. So if it is coming from that side, it will be 6%. So if you're, but please note that 8% or 6% is not the sacrosanct figure, that is a minimum figure, or the actual, whichever is higher has to be offered to tax under the presumptive taxation mode. Under the presumptive, they've also built in to say that if your receipt is less than 3 crores, you can still come under the presumptive mode if you are an eligible assessee, being individual HUF or firm, provided your left side of your receipt book is less than 5% in cash. your receipts less than 5% of your turnover, or gross receipt is less than 5% in cash. You can go up to this. So one very important point to be noted is 44AD, what we just now talked about, presumptive taxation, when it comes to business, is an option. You can decide to go in for 44AD, or you can say up to 1 crore, I need not subject myself to tax. And beyond that, below that also, I will continue to maintain books of accounts and comply with all the requirements of the law, and I will not opt for 44AD. But once I opt for 44AD, presumptive taxation, then I shall continue for the next 5 years. If I break the chain, I will have to. That means once I opt for it and I break, I want to show less than 8%, then I will have to subject my books of accounts for audit for the next 5 years. So that is the point to be noted. Next, we go to the specified professional. Who is a specified professional? Before we get into the rules for specified professional, any specified professional as told under 44AA, being a legal, medical, engineering, architectural, accountancy, technical consultancy, and interior decoration. And through notification, they have brought in authorized representative, film artist, company secretary, information technology, and sports activities. In fact, they have further broken up the film artists into various categories, from actor to dress designer. From sports activities could include the anchors, sports columnists, and things like that. So once we know who the specified professionals are, if you are a specified professional, then you don't have to get your books of accounts audited until your turnover is 50 lakhs. But a very important catch is, if you are a specified professional, you shall declare, it's not an option like 44AD. It is now we are coming under 44ADA. You shall declare 50% of your receipts as profit. If you want to show less than 50% of your receipt as your profit, then you shall get your maintain books of accounts and get it audited. So you are under obligation to show 50% of your profit as 50% of your turnover as total income or taxable income. However, one more exception is given. I mean, I don't know whether to call it as a benefit or a loss, because once you cross 50% up to 75 lakhs, you are given the benefit of presumptive taxation, provided you are left side, that is the receipt side, is less than 5% in cash. Cash receipt is less than 5% of your gross receipts. Why I'm saying it could be a problem is because up to 75 lakhs, if you are having a specified professional, you shall declare 50% profit and pay taxes on that. Otherwise, you have to otherwise you'll have to go in for an audit by the tax audit under section 44 ABA, read with 44 ADA. So in short, when are we supposed to get our books of accounts audited is what is shown in this particular slide, that if your turnover is less than 1 crore or 10 crores, as the case may be under 44AB. However, if you're choosing presumptive taxation, then it up to 2 crores and 3 crores, you have the liberty of going in for opting for 44AD presumptive taxation and don't have to get your books of accounts audited. Beyond that, you shall get your books of accounts audited. And if you are a specified professional, up to 50 lakhs or 75 lakhs being an exception, you can come under presumptive taxation and do not have to get your books of accounts audited. If you are coming under presumptive taxation, you don't even have to maintain books of accounts. You are not even covered under any of the sections told under section 28 to 44 AB. I mean 43C specifically. So your TDS, if you are not done, you will not be there will be no disallowance, or including your MSC payments if you did not do, you will not be subject to disallowance under section 43B. So there are certain advantages under the presumptive taxation. But now our session is on tax audit. Let me proceed further on the tax audit. So my next point that I will be talking about is the roles and responsibility of the tax auditor. So first and very important thing is, who can sign my tax audit report? My tax audit report can be signed only by a chartered accountant. Only by a chartered accountant in practice who is holding a valid certificate of practice. And can any chartered accountant sign my tax audit report? Now, can I sign the tax audit report of my own firm? The answer is no. Can I sign the chartered accountant in which any of my relative is a partner or a director? The answer is no. Similarly, if I were to be an officer of the entity, I cannot sign the tax audit of Karnataka Bank where I'm a director. Similarly, I cannot sign the tax audit of a entity where any of my relative is a director. Very importantly, when it comes to trust, a point to be noted is if I have contributed 50,000 rupees since inception to date, if I have contributed 50,000 rupees, then I cannot be the tax auditor of such a trust. So like that, there are certain disqualifications which are told under section 288 of the Income Tax Act, which are very, very similar to section 141 of the Companies Act. If I cannot be the auditor of a company under section 141 of the Companies Act, I cannot be the tax auditor of such a company. Similar restrictions are built in section 288 of the Income Tax Act to make me disqualified even for a proprietorship concern or for any non-corporate for that matter. Communication with the previous auditor, very important responsibility. In case there is a change in the tax auditor for the year, he has to write to the previous auditor stating that, is there any reason for me to know why I should not take this particular audit? So it's not exactly a no, I don't call it as a NOC. It is more a professional courtesy from the succeeding auditor to the previous auditor that he should write and take any objections that he has before he starts this particular audit. Before getting appointed, I would say, even for a company, there is a requirement that before he's appointed, he should get when the company approaches me, whether I am interested, at that stage itself, I should communicate with the previous auditor. Generally, I mean, in the bank audits and situations like that, also I have to take the communication. But if there is any urgency with which I have to start off, I will say I will get appointed, and only later on, before I start the work, I will have to get the communication from I will have to communicate to the previous auditor and get his NOC. In the normal context, it should be before the appointment. A very important point to be noted is on the ceiling on number of tax audits. Now, all these days, I mean, up until 31/3/25, the period for which we are doing the tax audit and for which the seminar is relevant, I can do tax audit of 60. Same thing continues in future also. But one very important thing is I am a firm of 7 partners. We have 7 partners in our firm. And can I as a partner sign 7 into 60, that is 420 tax audit reports? Say that provided all other 6 partners do not sign any tax audit report. Until this year, until 31/3/25, it was possible. And it was, I used to say, 420 numbers of tax audit report I can sign. But from the next year, starting from 1/4/25, there has been a change in the rule. They say that this 60 number is specific to the partner and not to the firm. So the quota all these days was 60 multiplied by the number of partners in the firm, and the quota was to the firm. Now the quota is shifted from the next year onwards to the individual. I cannot give my quota to some other partner in my own firm. I always keep telling, next year, if I sign 420 reports, Institute will consider me as a 420. So that is the point to be. That is a point to be noted. I cannot sign more than 60 tax audit reports. So this could be an issue for some of the partners who are sleeping partners. And that is why the Institute said every partner should be relevant. And I cannot practically sign more than 60 if I don't have I should not sign, because that is the maximum that I can actually do, is what the Institute feels. And again, one small change is it is specific to all these days. How many tax audit reports pertaining to previous years also I could have brought in within the quota. From next year onwards, it is specific to the tax year or the financial year. The number of 60 is specific to the tax year or the previous year, and not for all the years put together. A couple of next important point to be noted is on the UDIN. Every chartered accountant who generates should generate a UDIN before. I mean, I always have a practice of, when we were talking about the best practices for this session, the best practices is generate the UDIN before you sign. Just before you sign, you please generate. Once it is ready, you generate. Although the Institute gives you 60 days to generate. You can go backdate up to 60 days. You should, in case you forgot to generate a UDIN, up to 60 days you can generate. And also you have the right to revoke the UDIN generated in the 40, within 48 hours. Update in the IT portal in 15 calendar days of uploading. Otherwise, the tax audit report can become invalid. Now, this time, our institute, I don't know why they did this, but they brought in, when you are filing the tax audit report, the UDIN, when you are generating, the questions are being asked like, is auditor's opinion applicable to this audit? I mean, I have written a letter to the UDIN, our office has written to the UDIN secretariat saying that when can there be a situation where there is an audit but no opinion? I don't know when can there be an audit without an auditor's opinion, because every audit, according to me, has to have a conclusion. Maybe true and fair, maybe true and correct, but or certifying that the information provided herein is correct. So every audit should lead to an auditor's opinion. I have written to the secretariat to find out what can be situations where there is an audit but not opinion. When can this be? No, is what I have asked for them. The next thing that they have brought out is, what is the type of auditor's opinion that we have actually given? They have brought in unmodified, qualified, adverse, disclaimer. Now, all of us are aware that SA 700 is talking about unmodified opinion. SA 705 talks about qualified. SA 705 talks about modified opinion. Modification can be of three types, which is qualified, adverse, or disclaimer. So they have, instead of calling it as modified opinion, they have brought in qualified, adverse, and disclaimer of opinion. Then they have brought in from key audit matter SA 720, emphasis of matter SA 706, and other matter SA 706. Now, the problem with this type of thing is, if you choose one, you cannot choose the other. Again, I have written to the secretariat to say, in my audit report, there can be a qualified opinion, there can be a key audit matter, there can be an emphasis of matter, and other matter. You tell me what I should choose, because adverse, qualified, unmodified, and disclaimer, the first four can be mutually exclusive. But key audit matter, emphasis of matter, and other matter paragraph can still be there when all the four are there. But if I click, let us say, other matter paragraph, I cannot have a qualified opinion, but the actual report can have a qualified opinion, other matter paragraph. So for the benefit of all those who are attending this, now we are talking about tax audit report. In the tax audit report, mostly we don't have KAM or EOM or other matter paragraph. It can be either unmodified opinion or a qualified opinion, or that means it is not true and correct. It is, I don't know whether it is true and correct. That could be the point that I'm in. And generally, we don't have to, we will not be taking recourse to that. It could be either unmodified or qualified. But for the benefit of all those attending here, I would say it is better to say qualified opinion. I think we had discussed with Mr. Ramdevji also. I will give you what is the type of qualifications that you may have to give with respect to GST, clause 44, or clause 22 on MSc dues, because we may have to qualify there. And therefore, the answer for this type of audit opinion may be mostly qualified. A couple of things. One is, if you give qualification, if you say it is a qualified opinion, will the income tax department pick up all those cases which are having UDINs with qualification? Our institute has told that this particular UDIN, whatever is there, is only internal to the institute. I mean, they went on to say that this information will not be visible to any third party. If you go to the institute's website, they have put up a announcement where it says that the information filled in by the members on this particular UDIN portal will not be visible to any third party verifiers, will not be visible to any of the third party verifiers. So to that extent, anyway, even if the income tax department has to take up, we don't have a choice. Now, talking about we have to do the right thing. That's what I mean to say. We cannot say because the item can be taken up for scrutiny, I am not calling it as a qualified opinion is wrong. The best practice. We do what is required and we go ahead with that. And very important point I thought I should tell to all the audience at this point in time is, if you are an internal auditor, I'm coming out of the tax audit subject, going into the internal audit, I have seen for peer reviews or whatever, that when you have done an internal audit for a company, maybe let us say under section 138 of the Companies Act, or for that matter, any of the statutory requirement in a bank concurrent audit, even for that context, you will have to generate a UDIN. You may be an internal auditor, but you will have to generate a UDIN for that particular internal audit report. So going back to where we started, we were on this particular. So 3CA and 3CB. What is 3CA? 3CA is a report which we give where the audit is already done under some other statute. Let us say in the Companies Act wants me to do the audit of a company. So there I use 3CA. And 3CB is the audit report which is the form which I have to pick up in the context of the entity which is being audited under section 44AB for the first time. Only for the income tax purpose I am doing the audit. Most of the proprietorship, most of the non-corporates, let me put it like that, partnership firms or a HUF or a proprietorship concern will be getting audited for the first time under the Income Tax Act. Keep it aside, like in the case of a company, the audit report is required under section 143. You'll have to give a report under 143. So that report, when you are giving or an audit which is already done under a Companies Act or some other statute, a cooperative sector or an LLP also, if it is audited already because the turnover is more than 40 lakhs, or the contribution is more than 25 lakhs, or the form, the LLP agreement says that we have to get it audited, then I use form 3CA because audit report is already given. But if the audit report is not given under any other statute, then I use form 3CB. Very importantly, 3CA has got 3 clauses and 3CB has got 5 clauses. The reason being, in 3CB, you are giving in clause 3, the observations or qualifications on the financial statements, which in the case of a company you would have given in the main audit report, that you give it in clause 3 of clause 3CB. And clause 5 of 3CB and clause 3 of 3CA is similar. That is, this will give you the observations on form 3CD. The observations or qualifications with respect to form 3CD. Just now I mentioned that for clause 44 and clause 22, I will be giving you some standard templates. What are the qualifications that you may have to give with respect to GST or MSCs? That you'll have to give under clause 3 of 3CA or clause 5 of clause 3CB. Under the clause 3, let me take you to the clause 3CA. Just now what we saw, I'm sure all of us are familiar. Now when I'm talking about 3CB, in 3CB clause 3, clause 5, you will give the observations with respect to 3CD. But observations with respect to the financial statement itself, Ramdevji, you are talking about non-corporate entity format. The format for non-corporate entities was given by way of a guidance note by our institute and told initially that it will be mandatory for all non-corporate entities to give in a particular format, which is very similar to Schedule 3 of the Companies Act. Giving the format of the current assets, non-current assets, liabilities to be in the current liability, non-current liability, and things like that. Fortunately, because of the time not being there for getting ourselves trained, or maybe we have trained enough, but then the non-corporate entities were not given enough training. So therefore, our institute has deferred it by 1 year. So for financial year 24-25, the guidance note is not still mandatory. We still have to have the possibility of following the technical guide, which is only prescriptive and not as strong as the guidance note. For 24-25, even if you don't follow the format, it is no problem. Otherwise, we should have given a qualification in clause 3 of 3CB that it is not as per the format prescribed by the Institute of Chartered Accountants of India. Similarly, for a non-corporate entities, if any accounting standard is not followed, let us say AS15 on gratuity is not being followed, then we will have to qualify. If it were to be a company under the main audit report, I would have qualified. But now that it is under, for the non-corporate, I will be qualifying it under clause 3 of 3CB. I will be qualifying under clause 3 of 3CB. And again, let me also tell you that for non-corporates, until 31/3/24, non-corporates were classified as level 1, level 2, level 3, level 4 entities. Now, our institute from 1/4/2024 onwards, that is for financial year 24-25, when you are doing the audit for a non-corporate entities, you will have to consider the revised classification, which is classifying the non-corporate entities as MSCs and others, micro, small and medium enterprises and others, micro, small, medium enterprises and others. We will talk about that a bit later on. If there are any non-compliances with the institute's accounting standards for a non-corporate entities, you will have to qualify that in clause 3 of 3CB, because that clause 3 is talking about the observations, comments, discrepancies, inconsistencies in the financial statements. The financial statements should comply with accounting standards, and if the accounting standards are not followed, then it is not a qualification with respect to 3CD, but with respect to the financial statement itself, which you will cover it in clause 3 of 3CB, in clause 3 of 3CB. So next point, 3C and 3CB, we have understood. We will now get into the next aspect, which is how many sections, Naresh Chandra Gilligaru, how many sections are there in Form 3CD? I mean, that is being put up now on the screen, that there are, although in the Income Tax Act, they went on to say that there are more than 819 sections. 819 sections. Technically, there are 298 sections in the Income Tax Act, but in the Income Tax Act of 2025, there are 536 sections. How did 298 become 536? Because 298, 269 SS was one section, 269 ST was one section, 269 T was one section. So if you consider these three as three different aspects, it used to be about 819 sections in Income Tax Act 1961. Now they said we have reduced it to 536 sections. So that is how the numbers have got reduced. So let us not talk about all those sections. For tax audit, how many sections we need to know? There are at least 91 sections which we need to know. 2 sections, 91 plus 2, I have written plus 2, coming not from the Income Tax Act, but from the MSMED Act. Because MSMED Act has an implication on my reporting on Form 3CD. So 2 sections from MSMED Act, we'll talk about it. 5 chapters, 1 schedule in 3CD. So whoever is doing the tax audit should know at least these, should be familiar with these 91 plus 2 sections. Ramdevji, we are talking about ICDS. ICDS, I put IC under one block and DS as under another block, for the reason that IC, income computation, is a matter of Excel. Disclosure is a matter of Word. I mean, it is a disclosure of the various words. I mean, you will say so many as how the accounting has happened, how the treatment have happened with respect to stocks, revenues, forex, borrowing cost, and things like that. Now, in most of the cases, there may not be any computational difference with respect to income computation on account of ICDS, but there are at least 9 out of the, I think 8 out of the 10 standards where disclosures are required. So please ensure that under the clause 13, clause 13E may not be the impact of the ICDS on the total income, plus and minus is given in clause 13E. There may not be any. Although with respect to the closing stock and with respect to the inventory, we say accounting standards talk about exclusive method, whereas income tax talks about inclusive method. That means the GST should be added to purchases, added to closing stock. No, we always say you add in the purchases, add in the closing stock, the total income will not change. The profit will not change, even if you follow exclusive method or inclusive method. But you'll have to give all those as a disclosure under clause 13F of the tax audit report, under clause F of the tax audit report. So please, that is why I put TS in red to say that disclosures are a requirement under ICDS, which should be given in clause 13F. Revision of tax audit report, at least this year, we don't have that problem because September was the due date for filing the tax audit report, and October for income tax return. And if somebody were to pay a bonus either for Dasara or for Deepavali, which happened in October, and you have already filed your tax audit report showing bonus as payable, it will in fact be allowed up to 43B. All 43B expenditures will be, except for MSC payments, will be allowed until the due date of filing the income tax return, which is 31st of October. Now, in case you have filed the tax audit report in September and the bonus payment have happened in the month of October, then you shall revise your tax audit report, because otherwise the 143(1)(a) disallowance will happen with respect to those bonus which is actually shown as not paid in the original tax audit report. So now, of course, in our office and most of the offices, we have decided that we will file the tax audit report in October itself and ensure that it is paid, and then we'll show it and file. Just in case you have filed the tax audit report before and the payments have happened subsequently, you are under an obligation to revise the tax audit report. Whenever you revise your tax audit report, our institute in the guidance note has told that the next audit report should be called as revised tax audit report, and you shall generate a new UDIN for the revised tax audit report also. Next, SA 700. A point I always ask is tax audit report, can you do a test check when you're doing the tax audit report? Ramdev ji, can we do a test check when we are doing the tax audit report? What do you think? Can we do a test check, especially let us say TDS? TDS, when I am talking about TDS, can I do a test check with respect to TDS? Clause 34A wants me to tell me whether what is the amount of TDS done, whether it is done belatedly or whether it is done at the right rate, TDS done but not paid. Now we'll have to give all those in clause 34A. Can I do a test check when I am doing the tax audit report? 40A 1A, TDS, or 40A 3, or 269 SS, 269 T. Can I do a test check? Yes or no? So Ramdevji is saying no. I can make it out from his shaking of his head. Now, please understand, if it were to be Karnataka Bank, if it were to be Karnataka Bank, or for that matter, State Bank of India, the auditors of State Bank of India, or for that matter, Reliance Industries or Adani Industries, can they do 100% check of all the TDS that has happened if they are giving the tax audit report? And that is where our institute has come out to our rescue to say, as long as you are following the guidance, as long as you are following the standards on audit, which permits you to do the test check, you can resort to test check. Now, very importantly, the guidance note says for voluminous information such as TDS, or for that matter, any comment or MSC payments, can apply test checks, can apply the principles of materiality and do test checks and compliances for verifying information, provided I am satisfied with the internal controls. I am satisfied with the internal controls and I follow the standards on auditing. So very importantly, that means in my bank, I have a very strong concurrent audit, internal controls. So all these things, Ramdev, you will have to mute.
Sir, beside auditing standards, assurance standards are also there.
Yes, absolutely. Auditing and assurance standards. Sir, you will have to mute, sir. I think when you are putting it on, it is coming as an echo. आप म्यूट कर दीजिए. I'll talk about it and then ask questions. नहीं, आप म्यूट कर दीजिए सर. So yeah. So the point I was trying to say is the guidance, auditing and assurance standards. Yes, perfect. It was AAS earlier. Now it is called standards on auditing, which includes assurance standards also. Even when I am assuring, let me be very clear, although that I am assuring to the income tax department, see, in all the Companies Act, we say true and fair. The financial statements are true and fair. Whereas when it comes to 3CD, I am saying that the information provided in 3CD is true and correct. Does that mean that true and correct is at a higher platter as compared to true and fair? Our institute is very clear in the guidance note that they say that assurances can be of only a reasonable assurance, a limited assurance or a limited review, a reasonable assurance, and an absolute assurance. An absolute assurance can only come by way of a certificate. And now what we are giving is an audit report. In an audit report, I can only give a reasonable assurance. Even when it is true and correct, it is a reasonable assurance. And very importantly, I will have to ensure, even before I give my reasonable assurance, that the internal controls are strong. Otherwise, I have to do a 100% check. I have to do an 100% check. I have to comply with all the auditing and assurance standards. I will have to see that the information is filled in by the assessee, not by the chartered accountant. The information has to be filled in by the assessee and he has to fill in correctly. When I do the audit as a tax auditor, I can take recourse to the sampling or the test check. And very importantly, to minimize or to remove the expectation gap, because the income tax officer will feel that I have done a 100% test check. That is where they say, I will have to put in SA 700 wordings. What is that SA 700 wordings? You please see this. Yeah, this is the wordings that I have to put in my tax audit report, which says assessee's responsibility for financial statements and statement of. I will tell that he is the one who is filling in the Form 3CD. The assessee is responsible for the preparation of the aforesaid financial statements that give a true and fair view or true and a correct view of the financial position, etc. Then I will put in the auditor's responsibility. Our responsibility is to express an opinion. We have conducted this audit in accordance with standards on auditing issued by the Institute of Chartered Accountants of India. Those standards require that we comply with ethical requirements. So we have conducted our verification of the statement of standard in accordance with the guidance note on the tax audit. So this is the framework. The framework is standards on auditing and the guidance note on the tax audit, which I have complied with. So I will have to put these wordings in the form 3CA or 3CB in clause number 3 and clause number 5 respectively, if I am following the test check approach. And the last point on the responsibility is the audit documentation. Be peer review ready. I always say be peer review ready, and everybody has to be peer reviewed now. From next year onwards, you cannot do a branch audit if you are not subject to peer review. So what is the peer review looking into? You have to have a proper appointment letter, have a proper acceptance letter, have a proper engagement letter which spells out the terms of the engagement, what you are expecting the assessee to do, what you are expected to, what time frame, what is the fee expected, and things like that. And the management representation letter. Management representation letter on each of the points in the Form 3CD. There should be a representation by the management and other supporting evidences. All the supporting evidences like TDS challans or the TDS quarterly filing details and the bank statements, stock statements, etc., which has to be all retained for a minimum period of 7 years. And of course, the tax audit register, which will spell out how many tax audits you have done in the year. Okay. So with that, I can take one or two questions if they are ready. Naresh Chandra Garu, are there any questions? Otherwise, I'll proceed.
Sir,
Yes.
rather than question, I would like to supplement with a question
Yes, sir.
to
Please.
your question. In management representation letter, we don't know who is the relative regarding in respect of whom the requirement of reporting under 48(2)B is required.
Correct.
So for that, management representation letter is critical, no doubt. But
Correct.
it should be without compromising your integrity and verification of checking.
Absolutely.
That you must take care.
You are very correct, sir, because who is your brother, who is your brother's wife, who is, I always keep telling. Sir, आप खत्म कर दीजिए आपका question, because whenever your system is on, I think it's coming as anything.
Sorry for the inconvenience, sir.
No problem. No. You finish your question, sir?
No. And one more thing, in this reporting of 3CD,
yeah.
In view of this new financial formats for non-corporate entities, I would say that accounting standard 10 is very critical.
Yes.
With respect to depreciation.
Yes.
Because all non-corporate entities, as far as we know, they used to have depreciation and assets block maintained on WDV method, not on the gross block exactly as per Companies Act.
Yes.
So
I
what is the comment required to
no,
do?
I will cover these two. I will cover these two. I will cover these two in the following slides.
Sir, in addition to that, what I mean that if we if the assessee is not strictly following with the accounting standards 1 to 29, is it considered as true and fair view, or shall auditor say that it is not reflecting true and fair view?
Yes, sir. Take it. Sir, yes, thank you for this question. There are 2 points which he has raised. One is regarding the relatives. Yes, relatives, very importantly, Naresh Chandra Garu, relatives have been defined in Income Tax Act in 4 places. Do you know that? In 4 places. One in section 2, one in section 13, one in section 56, one is in section 288. Now, there are relatives have been defined in 4 places, and relatives for the general purpose 48(2)(b), what Mr. Ramdevji mentioned, 48(2)(b), relatives is defined in section 2. That is Aju Baju, Aage Piche, Upar Niche. Aju Baju is husband and wife, Aage Piche is brother and sister, Upar Niche is lineally ascendant and lineally descendant. Now, who are your brothers? Who are your sisters? Who are your lineal descendants? I wouldn't know unless the representation is given by the management. So to that extent, I have to rely on. So very importantly, management representation is a beginning. And like what Mr. Ramdev said, that will not be the end of it. If I know that some brother is actually, I'm doing a lot of transaction with a particular person and I know that he is a brother, which the management has not told that he's my brother, and I know that he's actually his brother, then I will have to override the management representation and do more than what is told. But the point is, management representation acts as a first level of defense, and I need to do more than the management representation itself cannot be the basis for my audit conclusion. I will have to do my audit procedures beyond the management representation. What that management representation can do is, tomorrow, if a mistake is identified by a regulator and there is a management representation, both the management as well as the auditor will be taken to task, not the auditor alone. I mean, I would like to say that I will have company in crime when it comes to when the management representation is taken. Second point is about the accounting standards. If any of the non-corporate entity has not complied with any of the accounting standards from 1 to 29 told by the institute, then that has to be a qualification in clause 3CB of the tax audit report. It has to be qualified. It will be true and fair subject to the following. It will be true and fair subject to the following. If it impairs the entire financial statement, it has to be a disclaimer on the financial statement. So I proceed further on the topic. Yeah.
Sir.
Yes, sir.
Sir, I'm Hanumanlu.
Yes, sir.
Sir, with regarding the accuracy required in 3CD, the TDS and statutory dues and loans received and loans repaid and cash transactions. We have to give only accurate figures. We did not give, it cannot be assured based on, it can give reasonable assurance also. I think we have to give total accurate figures only in 3CD. In 3CD.
Agreed. I fully agree with Hanumanluji. The figures that has to be given there cannot be on a test check basis. It has to be accurate. That is the word true and correct. Fully agree. Now, who has to give this figure? When we say we, who is that we?
Management, so company management. We have to verify and give that it is certified. No.
Agreed. Who has to give that particular figure? Management or the auditor?
Management has to give, yes.
Exactly. The point that I'm trying to say, the same thing. Now I'm coming to a very important point. In the guidance note of 2025, all these days we were saying that the assessee is responsible 700. We just talked about SA 700. Assessee is responsible for filling in the correct information. The auditor can do a test check. Auditor can decide to do a 100% check, or if he feels the controls are so strong and the material amounts are not material, I can definitely look into a test check basis. So very important, like what you said, the figures that are given in the tax audit report should be accurate, which has to be provided by the management. The auditor, when he does the test check, when he is doing the verification, he can rely on the sampling or test check basis. So that is why in the guidance note now, which I put up on the screen right now, second bullet point, guidance note makes it, let me just finish it off. Guidance note makes it abundantly clear that it is the assessee's responsibility to fill the tax audit report. He should fill in truly correctly. And so many paragraphs now, I as an auditor is saying that I am only verifying and examining the details. Earlier, the para 19.3 said while giving the particulars. Now I don't give the particulars. The particulars are given by the management. I am verifying and examining. So let me be very clear in this particular aspect for this particular session that I as an auditor am responsible for anything which is not correct. But out of, let us say, in a Adani or an Ambani or a big entity, in a small husband and wife company where I am required to do, I can do 100% check, I will do and I should do. But where the organization is so huge that they have got proper systems, then the organization has to give this information. I, as a tax auditor of that particular entity, I mean, jokingly, I used to say that what is your turnover? My turnover, in a, let us say, a Hyundai distributor will be some 2000 crores. Then I said, Ambani's turnover is also 2000 crores. 2000 crores per minute. Per minute, that will be his turnover, or per hour, that will be his turnover. When you work out the turnover for Reliance Industries Limited and look into the transactions, is it possible for the tax auditor of Reliance or any huge entity where the transactions are so huge that can I do 100% checking? So that is where I'm saying, if there is a proper system that everything that goes into their, let us say SAP or whatever, that a vendor is properly created, the moment it is done, TDS is happening, and there is an internal control, and there is an internal audit, a concurrent audit, and then I come in as a statutory auditor, I can rely on these systems, and they have filled in properly, and there is no, and I do a test check is possible. In a small entity, I shall do 100%, where there are no internal audits, no internal controls, I shall do 100%. And our institute also goes on to the extent of saying 40A3, 269SS, 269T, you can take the help of the technology. I think the opening remarks was also said, technology is very changing, and I can take the help of, I can ask my Google or my Tally also can show me payments of more than 10,000 rupees in cash. It will throw out. I don't have to do a sampling. I can do 100% for 269SS, 40A3, for all such things, 269T or things like that. But when it comes to TDS, if I ask the system to tell whether all TDS has already happened properly, it will not show. So that context is what I said. Yes, Samantha.
Sir, will it protect the auditor if it is not, it depends upon the ICA guidelines? Will it protect the auditor when the department takes action against the auditor? Will it protect?
Sir, I just now told you, this is the protection. I put up the guidance note, makes it amended that it is the assessee's responsibility to fill the tax audit report properly. I am only verifying. And I also told you here that our institute said that SA 700 format, disallowance under 40A1A for voluminous information, tax auditor can apply materiality principle and test checks and compliance tests for verifying information required under clause 21B or clause 43, clause 34A. It is all told in the guidance note, and it will protect. But you'll have to be very clear that the internal controls, you'll have to have proper document to share that the internal controls have been verified, the internal audit is happening, the concurrent audits are happening. Then you can take recourse to this.
Thank you. Thank you.
Yeah. So we proceed further. Notable changes in the guidance note. In fact, this year they released the guidance note on 30th of July 2025, which is 585 pages. They have made reference to the guidance note on financial statements of non-corporate entities being mandatory, because at that stage it was not told to be optional. Subsequently, it became optional, but next year anyway, it will be there. So for some of the non-corporate entities, we have already signed with the format, and after the guidance note, we are taking it easy. But the accounting standards is made mandatory for non-corporate entities for 24-25. Just now what I told, micro, small and medium enterprises and others. If you are still using level 1, level 2, level 3, level 4 for non-corporate entities, you are doing a mistake. Then second point is, Ramdev ji, aapko mute karna padega, please.
Sir,
Sir, my request to all the participants, when I come to a question station, I will ask you to ask questions. Because let me finish off this slide and I'll come to the question station. Yeah, please mute it, sir. Please mute. I'll come to that time. Yeah. So while verifying the report on 269SS, a very interesting point, 2 crores I had borrowed, and during the year there was interest of 20 lakhs. Let us say 10% interest on 2 crores, 20 lakhs interest gets added. So it becomes 2 crore 20 lakhs. Now, how did I take this money of 20 lakh rupees, 2 crore loan becoming 2 crore 20, Naresh Chandra Garu, did I take this amount in account paid check, account paid draft, or Rule 6 ABBA? Because 2 crore becoming 2 crore 22 is through a journal entry. I mean, I passed an entry for interest, 20 lakhs. Now, the question that was being asked is, should I report under this particular clause as yes, it is taken other than by an account paid check, account paid draft or thing. So what our institute initially told is, if 2 crores is a loan amount and 20 lakhs is kept as a separate interest payable account, then you don't have to report. But 2 crore becoming 2 crore 20 was subject to it being reported under 216SS as taken otherwise then in account paid check, account paid draft. But then they went on to say 271D penalty will not be applicable in this case, but the auditor has to say that it is taken otherwise than in permitted modes. But this time they have been very clear to say, and I fully agree with this particular statement, interest accrued during the year and credited to the deposit or loan account is not required to be reported under this particular clause. So 2 crores becoming 2 crore 20, you don't have to, if it is only by virtue of interest accrual, you don't have to report, is very clearly told in this guidance note. Until last year, we used to keep it in a separate account just to say that, no, otherwise I had to put it, and yes, it is a violation. And if it is a violation, there will be a show cause. To avoid all that, we used to keep it in a separate account. Now we can merge it. And by merger, I have the benefit of having, let us say, a current ratio and improved current ratio. If I show it as interest due accrued, then it will be a current liability. Then the next question is futures and options, the most debatable one. Futures and options. How do I decide whether I have to do a tax audit on futures and options? There they said the turnover has to be decided, because most of the salaried employees today are doing futures and options. So whether I have to do a tax audit of such a salaried employee, for that they said your sum total of your positives and negatives. Let us say I invested 1 crore and I got 1 crore 30 lakh rupees as my profit, 1 crore 30 as my return. So 30 lakhs is my profit. And again, I invested 1 crore and I got only 10 lakh rupees as my return. 90 lakhs is a loss. So 90 lakhs loss plus 30 lakhs profit, sum total 1 crore 20 lakhs. So sum total of the loss and sum total of the profit has to be added. A very, very funny way of telling it to a chartered accountant. You have to add the loss and profit and combine it together without the signs and call it as the cutoff for the purpose of determining whether it is a tax audit. If it were to be a tax audit of 1 crore 20 lakhs, and if he's not opting for 44 AD, I am afraid you will have to get his books of accounts audited. So that is what has been there told since beginning. But what is the change? Sum of favorable and unfavorable differences only for squared off transaction. That means I have invested 1 crore. As on 31st of March, it is still there as investment and not squared off. I don't have to consider that. That is also there since beginning. To determine the tax audit limit only, that is also there since long. What is a special thing that they have told in this year is, and does not alter its treatment for income classification under the head capital gains or business or profession. So this yellow shaded portion is new, and it has created a lot of debate in the profession to say, is it possible for futures and options to be called as a capital gain? I would not like to open up the debate on this particular matter, but our institute has opened up a debate to say that I am not telling you whether futures and option is business and profession is a business or it is capital gains, because all the while we were thinking that it is a business. But now, if it is a capital gain, I can probably go away by paying 15% instead of the regular 30% if I were to be in the highest tax bracket. So our institute has left it. Futures and options, I am telling you that how to determine the limit and how to do the tax audit, but I am not telling you how to classify it either as a capital gain or a business and profession. Very interesting aspect opened up by the institute. Revised tax audit report we already discussed. Audit engagement letter and management representation letter, there has been a format given for the first time for tax audit in the guidance note. All these days we used to rely on the audit engagement letter SA 580, the management representation SA 580. So we used to look into standards generally and design our own representation letters. But now the guidance note has given a management representation letter which is very specific for tax audits. You may use it if at all you feel like. And they've also given a tabular comparison between 44 AD and ADA. Let me just go forward. Earlier guidance note in 2023 was there important, which is continuing. I just thought I should bring it to your knowledge because we were also talking about some case laws, important case laws. Now, Naresh, if I'm sure you are a firm, you are a partner in a firm, and now you must be getting, let us say, 2 crores as your share of profit, remuneration, and interest. Now, you will be this 2 crores in your hands will be as income from business or profession, income from profession. Now, since your income from profession is more than 50 lakhs, should you get your books of accounts audited? Firm is subject to tax audit, yes. But now individually, since you are getting 2 crores as remuneration and interest, one may say that the share of profit is exempt from tax, so therefore you remove the exempted category. Now let me see, if you remove the share of profit, you still have 1.5 crores as interest and remuneration. Should you get yourself audited?
No, I don't think it should be audited, no, sir.
So what is the basis, sir? Until this particular case law came into picture in 2022, the Bombay High Court made it very clear that if a partner is receiving the remuneration and interest from the firm, he is not different from the firm. Since the firm is already audited, you don't have to get yourself audited.
Correct.
Until 2022, there was a tribunal decision which went on to say that because you are offering it under professional income, you shall get your books of accounts audited. And in fact, I was subjecting my personal income tax for tax audit for this purpose until 2022. I got it done. In 2022, Perisad Zorbian versus PCIT, Mumbai High Court came out with this particular verdict, and our institute in the guidance note, they have built in within the guidance note to say such an individual who is getting a share from his own firm need not be subject to audit. This is the final picture, sir. What you said, I don't think is now definitely not required.
Okay.
What? Yeah. Otherwise, we should have, because the department looks like 2 different pans. We are 2 different pan. Your pan, you are more than 450 lakhs, so therefore you have to get it audited is their answer. Now you don't have to. Now, warnings about normal mistakes have also been told in this particular guidance. I will talk about that. Then no place to mention UDIN. The guidance note said there is no place to mention UDIN. How do I do it? Means they said that you take a hard copy and sign it and put the UDIN there. And hard copy and soft copy of the financial statements must be obtained. Take a hard copy and get a signature, although digital signature is also possible. SENVAT, clause 27A talks about SENVAT. Nowhere it talks about ITC. Now, a lot of questions that keep coming out is, should I still give ITC details? Although the question is, please look into the income tax rules. It talks about SENVAT. Somewhere in the schema, they have brought in ITC. So clause 27A, our institute is very clear, and I am also not giving any details with respect to ITC because it is talking about SENVAT, and SENVAT is applicable to only petroleum, alcohol, very, very few cases. So therefore, ITC details need not be, GST details with respect to ITC need not be given in clause 27A. And if turnover is more than the limit and he's carrying on the business, then tax audit is required even if the income is exempt. That is a thing which came out as a shocker to us. Agriculture was considered exempt, but now struck off. So what it means is, if entire income is exempt, you don't have to worry. You don't have to do a tax audit. If somebody has 100 crores of agricultural income, you don't have to do a tax audit. But if he has, let us say, 50 lakhs of exempted income and another 75 lakhs of taxable income. So 75 plus 50 is more than 1 crore. And if it happens to be a company, or if it is not opting for 44AD, you shall consider that exempted income also for the purpose of the cutoff of 1 crore tax audit ceiling. Both under inclusive method and exclusive method, gross profit will remain the same. But 2 illustrations explaining the above in the earlier guidance note is removed. and disclaimers with respect to clause 33 and clause 44 has now been properly given in guidance note 2023, which is continuing even now. Okay, yeah. Now we go to the common mistakes, and then I will open it up for question station, sir. So common mistakes identified by the Tax Audit Quality Review Board. Not reporting. I think what generally happens is, I said that SA 700 is the reporting has to be given in the financial statement in the tax audit report clause 3 of 3CA or clause 5 of 3CB. If you don't give that, that means you have not followed the standards on auditing or not followed the guidance note of the tax audit of the institute. So all these things are there in that particular. So please copy and paste it. It is there in the guidance note. Please paste it. And of course, you'll have to comply with the wordings as told in SA 700. Relevant clause of 44AB is not properly selected. Now, Hanumantluji, the point is, if it were to be a company which you are doing the tax audit, if it were to be a company where you are doing the tax audit, let us say that our company's turnover is 12 crores, you are doing the tax audit. Now, there is a particular section, I think in clause 3 or 4, under which section of 44AB you are doing the audit. 44AB, A, B, C, D, E. You know, these are the clauses under which you are doing the tax audit. Now, which clause are you ticking? Are you ticking clause A, B, C, D, E? Normally we are ticking clause A because 44AB clause A is for business. Now, B is for specified professional. D, E, F is for presumptive cases where they have not given the shown the profits, and therefore the audit has to be done. Now, please note, if you come to this, there is one more proviso, third proviso to section 44AB, which says, in the case of a person where such person is required by or under any other law to get his accounts audited, because 44AB reads like you are doing the audit for the income tax purpose for the first time, where you are using clause 3C, where you are using form 3CB. That is applicable. 44AB, A, B, C, D is applicable only when you are using form 3CB. When you are using form 3CA, the third proviso to section 44AB should be ticked. Now, if you come to this particular point, this is under clause 8. Clause 8 may A, B, C, D, E, F, and proviso to clause A, business turnover up to 10 crore. Third proviso, audit under any other law. So you have to tick third proviso under any other law. Because you are using form 3CA, it is a case where a person is required by or under any other law to get his accounts audited. It shall be sufficient compliance with the provision of this section 44AB if such person gets the accounts of such business or profession audited under such law before the specified date and furnishes by that date the report of the audit as required under such other law and further report by an accountant in the prescribed form, which is 3CA. So in all cases where 3CA is given, if you tick 44AB, you are wrong. So what our institute says is, most of the cases which has been picked up by Tax Audit Quality Review Board, they have found out that people are ticking A for even companies. So that is wrong. So please tick proviso, third proviso to 44AB. Then clause 11, books of accounts prescribed. The question is, are books of accounts prescribed? Means most of the people, they say yes. Even in the case of a company, they say yes. Every company has to maintain books of accounts. This is what is told in 44AA. But specified books being prescribed, whenever we say prescribed, it should be through a rule. The rule prescribes books only in very few cases, that too in the case of doctors. In the case of specified professionals being doctors, books of accounts have been prescribed. They have to maintain what is known as an inventory register and a patient register. So only in that cases it is prescribed as yes. In all other cases, books of accounts prescribed means we have to say no. Maintained in a computer system is not reported. We have to say it is maintained in a computer system. Address where it is maintained must also be mentioned. It is not being mentioned. ICDS we talked about. For all ICDS except 6 being forex rate and 7 being securities, there is a requirement for disclosure unless you don't have that component at all. For example, inventory, we say you have to have a policy for inventory, inventory, how inventory valuation. If you don't have inventory, then you don't have to have a policy for inventory valuation. Otherwise, all other 8 out of the 10 ICDS, there is a requirement for you to give some disclosures which are required to be given, which is missing is what the TAQRB is telling. Then 5, tangible fixed assets, same as clause 18. Reference not given. Then inventory valuation, inclusive and exclusive, you will have to give that particular note. Inventory, very interestingly, Naresh Chandra Garu, this is talking about English. ICD Accounting Standard 2 talks about inventory valuation as cost, lower of cost and net realizable value. Lower of cost and net realizable value. ICDS uses cost and net realizable value, whichever is lower. So if you are using Accounting Standard 2, lower of cost and net realizable value, and in this it is using or. So what is told is, for purpose of Accounting Standard use yes, for the purpose of ICDS you have to use or. I mean, the wordings are so very particular that you have to use that particular wording only. Then 50C and 43CA, we are aware of 50C wherever the sale value of an immovable property is done at lower than the guidance value, you should show the sale value as minimum the guidance value. So under this particular clause, you will have to kick in only if it is at lower than. If you have sold the guidance value is 10 crores and you have sold it at 12 crores, you don't have to report anything in that particular clause. Institute says that a lot of people are reporting even when it is at a higher value. Fixed assets. Additions in tax audit report is not matching with the property, plant and equipment schedule in the financial statements. So if whatever is there in the as a company's guidance fixed asset schedule, additions and the additions under the Income Tax Act need not tally, but you will have to give a reconciliation is what they are saying. Generally, it should tally. Date put to use or transferred, same for all assets, most likely not correct. For all assets, the same date of them it is put to use may not be correct. And I always keep telling this in our office. Whenever a building is constructed, I buy cement, steel. The date of buying the cement and steel is not the date of put to use. The cement and steel will all finally become building. The date of putting the building to use is the date. You cannot have the various components as the date of put to use. And if I bought something before Gandhi Jayanti, I always say, Naresh Chandra Garu, that Gandhi Jayanti is the cutoff. Anything that you buy before Gandhi Jayanti, you are eligible to get 100%, full depreciation. Anything bought after Gandhi Jayanti, you get 50% of the eligible depreciation for that particular year. Because 182 days, that is the cutoff. Now, you cannot have, cement, steel, people, if you don't know, they go just based on the bills. That is the date of additions. The date of addition is not the date for the purpose of depreciation. It is a date put to use. So you don't put to use the cement and steel separately. You put the building to use. So that is a point to be noted. ES and PF. PF reported, but ESI not reported when it was evidently applicable. Then late filing fee under 234E or additional filing fee to ROC, not penalties, but reported as so. Now, there is a clause which says that what are the penalties which needs to be disallowed. The penalties means for violation of any act. Additional filing fee, ROC filing fee, additional ROC filing fee, 234E, these are all fee. The difference between a penalty and a fee is, in the case of a penalty, there is always a show cause. Before levying a penalty, there must be a show cause. The additional filing fee, what we pay to the ROC, is not a penalty. We can claim it as a deduction. Penalty or fine for violation of law. Report this separate compared to other penalties. Then reported, so one of the companies, there was a contingent liability. That contingent liability in the financial statement got reported under clause 21G. But clause 21G says contingent liability being debited to P&L account only should be reported under 21G. If it is a contingent liability which is shown only as a disclosure, that need not be reported under clause 21G. In clause 25, remission of a liability has to be reported. One of the problem with the remission of a liability, if you report it, it will again be taken up. It will be taken up as an addition in your computation. So most of them are not adding because it will be taken up during the 143(1)A scrutiny. But for that, I am always saying, in your profit and loss account, if it is already credited, you still have to report under clause 25 what is the remission of liability. But in the computation of income, what you do in the profit, you deduct the amount credited to your profit and loss account and then add back the same amount as remission of liability, and then it will not be added back again in 143(1)A. Okay. Yeah. now I come to the question station. Any questions, sir, before I go into the changes in the tax audit report? Yes, Ramdev.
Sir, the 2-3 points I would like to share with you, sir.
Sir.
Regarding this accounting standards, compulsory mandatory to be followed. Legally speaking, they are not mandatory on the part of the non-corporate entities. So generally also we are saying that they are not general purpose financial statements are different from the financial statements prepared by these non-corporate entities. So these are not obligatory on their part. In the preface to accounting standards, it has been explained. So we are giving always comment in the notes on accounts that these are not obligatory on part of the non-corporate entity. That point is there. So with that point, now this again new format has been prescribed, which is to be followed by the taxpayer or assessee, but they are not following. So in class 3, we are simply giving they have not complied with the format, etc. Also, shall we add that the accounting standards are not complied, are not obligatory? First thing. And one more thing, sir, you can take up that also. Regarding this depreciation, block assets, whatever we are reporting in Form 3CD in a form of table in the clause 18 of the Form 3CD. But in ICDS, again, it has been asked. So it is enough to write there that as reported in Form clause 18. Yes, sir, these two things, sir.
Yes, thank you. So I'll just answer, sir, one by one. One is regarding the accounting standards and formats is definitely not mandatory on the entity because our institute is not a regulator for the non-corporate entity. Just like in the case of a company, Companies Act makes accounting standard within the Companies Act itself, and Schedule 3 is there within the Companies Act itself. So therefore, for companies, the Companies Act itself is telling the companies to do. And auditor also has to monitor. Whereas when it comes to non-corporates, the non-corporate ke liye koi, there is no mandate that they have to follow it in a particular format. But what has been told because of the guidance note, of course, now this is made optional for this year. Again, I'm reiterating on the non-corporate financial statements. It is made mandatory from next year, at least next year when it comes. If you don't follow as an auditor, if the entity does not follow, it becomes the auditor's responsibility to bring out that fact in the audit report. Because the guidance note is mandatory on me. I have to report it, even with respect to non-compliance of an accounting standard or non-compliance of the format of financial statements has to be reported. Again, with the qualification that financial statement non-compliance need not be reported for this guidance, this year's tax audit report. Non-corporates not following the accounting standards as told has to be reported. How it has to be reported, I will tell a bit later on. As far as the second question is, our guidance note has also told that if similar questions are there or similar comments are there, you can cross-reference. एक जगह में देके दूसरा जगह में you can always say that it has already been reported under that particular clause. So that is answered. Next, any other questions, Naresh Chandra Garu?
Hello. Sir, with regarding that penalties and late charges.
Yeah.
Penalties and late charges. Majority of the charges are, though it is called penalty by the regulators, but actually it is only regulation fees. Just like municipal tax. Municipal tax is collect with interest. It is only interest. It is not penalty. But they mention sometimes it's penalty. So how to protect that? It is penalty is only finance cost. It is not the violation of law. It is regulation. It is how to do it separately. How to mention separately in the 3CD.
Sir, if it is a penalty for violation of any law, then that only is disallowed under section 37.
Yes.
Okay. They may call it as penalty, but it could be in the nature of, let us say, additional filing fee or interest There are a lot of case laws to say that interest on late payment is not a penalty. It is only compensatory in nature. So therefore, that should be an allowable expenditure. So as a tax auditor, I will not give that. However, if you have any doubt, you may, our institute always keeps, not only with respect to penalty, the auditor has to bring out any of the facts in his audit report and say that it is not to be disallowed, giving a particular case law. When in doubt, disclose. Having said that, if it is an additional filing fee or an interest, there is no doubt that it is not a penalty for violation of any law.
With regarding the example with regarding TDS, you have to pay late fees as well as interest. These two charges will be there. We have to bifurcate.
Now
TDS delay in filing return or payment of TDS.
That is very unfortunate, sir. Interest on TDS, whether it is an allowable expenditure, is a very debatable issue. Initially we never used to disallow, and now we are actually disallowing, because anything which is with the income tax department, any taxes to the income tax department, unfortunately, whether it is, for example, interest under 234 ABC is also compensatory in nature. Whether interest under 234 ABC is an allowable expenditure means the answer is no.
TDS deducted and not paid is not valid. The penalty has to be levied and that has to be disallowed. But interest not, TDS not deducted, and after, of course, it was forced to deduct after some time. Deducted delay and filed a paid delay and filing also delay. That situation.
The point is, sir, there are a lot of case laws against, in fact, when it comes to interest on TDS, what you are talking about is unfortunately, we are debating it, whether it should be disclosed. In our tax audit report, we are calling it as a not allowable expenditure. It could be a debatable thing. Interest on GST is an allowable expenditure, but interest on income tax or TDS is not an allowable expenditure, because income tax itself is not allowable. Therefore, whatever follows with income tax is not an allowable expenditure, is the view that we have taken in our office.
In my opinion, GST, interest on GST also is just like penalty, because GST collected and it has to pay to the government. It is others' money, government money held by the payer. So
very important point, sir. Very important point. If you have collected the GST, that is why we are saying inclusive method. Yes. Inclusive method has to be followed. If you have collected GST, that has to be offered. GST itself will become an income. I am not talking of such situation. I am talking of GST collected but paid delayed with the interest. Whether that interest is an allowable expenditure, interest on GST is an allowable expenditure, it is an allowable expenditure.
Yeah. I differ, sir. I differ. Okay, thank you.
Thank you, sir. So next point is, we'll move to the changes in the tax audit report, which happened. There are about 9 changes which have happened. I will not talk about all the 9 because all the 9 are not equally important. Clause 22 is very important. Clause 12, they added whether P&L account includes any profits and gains as assessable on presumptive basis, to include reference of section 44 BBC, dealing with the special provisions for computing profits and gains of business of operating cruise ships of non-residents. So that is relevant only to them. Then omission of redundant sections 32 AC, 32 AD, AC, CCB, dealing with amounts admissible. So they have removed 32 AC and 32 AD. If you remember, this was to deal with some special allowances for those who put up. I think even Andhra Pradesh was covered under 32 AC. Special provision, additional depreciation being given and things like that. Now that had a sunset clause, therefore they have removed that. Clause 21, dealing with the amounts debited to P&L account being in the nature of capital, personal, advertisement expenditure, etc., to include expenditure incurred to settle proceedings initiated in respect of contravention under such law as notified by the central government in the official gazette. Now, this is a point where we need to stray. Section 37, because clause 21 deals with section 37. Section 37, we know we'll have to give disclosures as to whether it is a capex expenditure has to be disallowed, personal expenditure has to be disallowed, any penalties for violation of law, penalty for violation of law, the law either in India or outside India has to be disallowed. Then they went to the extent of saying, if it is an expenditure which will become which is from the other man's point of view, it is not, ethically correct. the code of ethics says that the other person should not take it, then the expenditure which I make should also be disallowed. I think it's very important for Andhra Pradesh. There you have a lot of medicine, the drug manufacturers who give incentives, who give incentives to doctors to prescribe their drugs. And the hospitals or the doctors have been given under the IMA or the code of ethics, they said that you should not take any incentive to prescribe the medicine. Now, if that is a violation, taking is a violation, then giving is also a violation and it will not be allowed. Any expenditure incurred for, let us say, sales promotion to pay to a doctor, which is, according to the code of ethics, a violation from the receiver will also, I'm just giving an example, will also be a disallowable expenditure under section 37. Then they also brought in last year compounding of any fee. Instead of paying penalties, you're paying compounding fee. That will also not be allowed. And the last thing which they introduced last year was any expenditure incurred to settle proceedings. Now you have probably what it means is an out-of-court settlement. Out-of-court proceedings. I have there was a case against me. I am claiming a damage of 1 crore, and I came out of the court and said I have violated, and therefore I have to pay him 1 crore. But out-of-court settlement has happened between us, and that will be also disallowed, provided that law as notified by the central government. Now, have they notified any law? Yes, that is the point which we have to see. In the month of April, they notified 4 laws. So any out-of-court settlements which happen on account of SEBI, Security Contract Regulation Act, Depositories Act, and Competition Act will be considered as a disallowable expenditure for the purpose of section 37. That's a point to be noted for clause 21. Clause 22, they have inserted, or rather changed, they amended the clause 22 itself. We will deal with that in detail. Clause 26 also we will deal. Clause 28, I will finish it off, dealing with whether during the previous year, assessee has received any property being share of a company without consideration or for inadequate consideration referred to in 5627A. If you remember, this is what was called as a 5627A became 56210 eventually, 56210 eventually, for which there is a separate clause. So therefore they deleted clause 28. Clause 29 was also deleted. This is dealing with the angel tax. In the case of a closely held company, if I have received any share capital beyond my fair market value, that excess was being taxed in the hands of the private limited company, that they have abolished from 24-25. Financial year 24-25. So therefore, clause 29 has got deleted. Now, clause 31 dealing with 269SS, 269ST, 269T, they have brought down drop-down menu. We'll have to be very picking up the menu. I think this is how it looks like, the drop-down menu. Yeah. So for each of the payments, now they have brought in a drop-down menu to say whether it is paid by cash payment, cash receipt, payment through non-account paid check, transfer of asset, liability, journal entry, or any other mode. So we have to tick the appropriate box for 269SS, ST, and T cases. And they've also amended to disclose buyback shares in clause 36B. If you remember, the buyback was earlier taxed in the hands of the company which is buying the shares. Now it has been shifted to in the hands of the receiver of the share value. Once I sell my shares to the company, I have to pay the taxes under section 222F. I will have to pay the taxes without claiming the investment in shares as a deduction. This will have to be paid as dividends. Now, Infosys is coming out with the buyback. So if I surrender my shares to Infosys and I've already invested, let us say 1 crore, and they are giving me 2.5 crores against that. So I will have to offer entire 2.5 crores under 222F as a dividend, and this 1 crore investment which I made to buy that particular share can be claimed as a capital loss against any future capital gains. Unfortunate, I may not surrender I may not offer my shares for the buyback itself. So that is about clause 36B. Let's get into clause 22 and 26. Clause 22 is a major change. What was shown as amount of interest inadmissible under section 23 of the MSMED Act, or any amount not allowable under section 43BH of the Income Tax Act 1961. So this is what was being shown earlier. Now let me just in 2 minutes recap what is section 23 of the MSMED Act. Section there is a MSME Act protects the micro and small enterprises only, not the medium enterprises. Let us be very clear. If I don't make the payment to them within 45 days, or in fact, what they said is within the agreed period, which shall not be more than 45 days. If there is no agreement, it shall be paid within 15 days. Within 15 days. If there is an agreement, it shall be paid within the date of agreement or 45 days maximum. So if you pay beyond the overdue period, what I can say, you shall pay him an interest of 3 times the bank rate. And Section 23 of the MSME Act says that particular interest is not allowable for income tax purpose. MSME Act is telling that notwithstanding anything told in Income Tax Act or any other act, that interest which you pay to the micro and small enterprise will not be allowed for income tax purposes. So that is what has been required to be shown there, or any other amount not allowable under Section 43BH of the Income Tax Act. All of us are aware from last year onwards, there came another draconian provision which said not only this interest, if for such a micro small enterprise, the due date is over as on 31st of March, the due date is over on 31st of March, it is overdue on 31st of March, then that entire expenditure will be disallowed. Entire expenditure will be disallowed. And like any other 43B family, it will not be allowed till, even though you pay it by the due date of filing the income tax return. So if you pay by 31st March, only it is allowed. And the only exception to that is if the due date is still available to you beyond March. So let us say I bought something on 15th of March. Then I will probably using the 45 days, 30th of April is the due date. So if I paid by 30th of April, it will be allowed for this particular year. Otherwise, it will not be allowed. So we are all familiar with this particular thing. I will not drag in now. So any other amount not allowable under Section 43BH of the Income Tax Act. So this is what we were required to report. Now, when it comes to the post, they have split this into 1, 2, 3, A and B. 1 it is equivalent to what was earlier, amount of interest inadmissible under Section 23 of the MSME Act. So we'll have to give that. So next thing is or. In fact, they should have not used the word or. And it continues even now as or. Our institute in the guidance note, they said the or should be read as and. So forget about it. Total amount required to be paid. Total amount required to be paid under MSME and under to a MSE under Section 15 of the MSME Act during the previous year. Look at this. Total amount required to be paid. That means all the amounts in the P&L account and in the balance sheet also. If there were any amounts required to be paid to the micro and small enterprise during the year, you will have to give that. Required to be paid. Out of the amount referred to in 2 above, let us say what you give under 2 will be 1 crore. I'm just putting in a small organization, 1 crore I was required to pay. Then under A will be paid up to the time given under Section 15 of the MSME Act. That means you have paid within the due date. Let us say 75 lakhs I have paid within the due date. Under B, not paid up to the time given under Section 15 of the MSME Act and inadmissible for the previous year. Means not paid within the due date and not paid by 31st March also, or not paid by the due date like 30th April if it is allowed, the due date is available. So please note, under 2 you may put 100 lakhs, under 3A you may put 75 lakhs, 3B is not 100 minus 75, 25. Because 25 is delayed payment, but what I want in B is not only delayed payment, but delayed payment. If it is set right by 31st of March, I don't have to disallow that for income tax purpose. So please note that not paid up to the time given under Section 15 of the MSME Act, itna hi hai to I would have given 25 lakhs, but they have used the word and inadmissible for the previous year. That means inadmissible under Section 43BH for the previous year means if nothing, maybe out of the 25 lakhs, I have cleared everything by 31st of March. So under clause 2, I may say 100 lakhs. Under clause 3A, I will write 75 lakhs. Under 3B, I will write only those amounts which have to be disallowed for the purpose of income tax because it was not paid by 31st March or the due date available beyond 31st of March. So what are the challenges? What are the challenges? The challenges is, first of all, of course, like in any other audit, in the before this change also, we have to note for this particular change, 2 minus 3A is not 3B. So I will always say how to fill in this means you start filling it up with 3B. What is the amount to be disallowed under 43BH? Maybe a smaller portion or no portion. That should be filled up first, because if you make a mistake in 2 or 3A, there is no problem. But if you make a mistake in 3B, that will be the amount which will be picked up for additions under 143(1)(a). Okay, so be very careful when you are filling in this particular clause. Don't give it to a junior. Please monitor it when you are actually filling in this. Otherwise, getting this item in number 2 itself is very difficult. Total amount required to be paid to a MSME, micro and small enterprise. Please understand, micro, small and medium. Medium need not be included. So who is a micro and small enterprise? We know, although from 1st of April 25, there has been a change in the criteria. The turnover criteria and the return on value of investment in plant and machinery is changed. Until last year, it was, up till 31/3/25, it is 50 crores investment turnover or 10 crores investment in plant and machinery. Return on value of the WDV of the income tax plant and machinery should be 10 crores. So if that is there, then you are an MSC, micro and small. If you are an MSC and if I am buying from such a micro and small enterprise, this has to be done. So what has to be done? Is there any disallowance for a fixed asset? Let us say I buy a furniture from a micro and small enterprise. Should I disallow that? The answer is no, because I have not claimed it as an expenditure at all. I am a garment manufacturing, buying furniture from a MSC. I don't have to disallow. Although I can claim depreciation even if I don't pay. That's not depreciation is not an expenditure, it's an allowance. Now, having said that, for the purpose of clause 2, I have to give even furniture, because total amount required to be paid to a MSC under section 15 of the MSMD, it goes to capital items also. Paid up to the time given under section 15 to capital items also. But what is required to be shown under B is only the P&L account item claimed during the year, which has to be disallowed. There are a lot of challenges in this. It is not an easy thing to fill up this particular. So what we have to do as auditors, do our best in finding out whether the classification is properly done and whether the information is properly received. Otherwise, you will have to slice just like for clause 44, you will have to find out whether each of the expenditure is from a GST vendor, whether a registered GST vendor, unregistered GST vendor. Similarly, you'll have to now dissect your P&L account and balance sheet. How much of your P&L item is from a micro and small enterprise and others. Very, very difficult. Maybe 3B is easy for me to calculate, because from my total sundry creditors payable as on 31st of March, what I will have to do is how much is creditors from the opening. I will remove that. How much of the creditors are from non-corporate, non-MSC, that is large or medium, I will remove them. How much is from capital goods, I will remove them. Only that I will have to concentrate for the purpose of disallowance. Now, for the purpose of clause 2, it becomes very, very difficult for me, because I have to dissect the P&L account. So what we have done is, we have said that we have asked the entities we have sent a letter like this to all the entities. The following information is now compulsory required to be reported. Total amount required to be paid to MSME out of the above, paid within the time and not paid within the time. So action required from your end. We are telling the assessees to streamline compliances and to enable us to report. Please give us this particular information. If this information is not made available, we will be constrained to qualify the tax audit report accordingly. Now, what is the qualification? I think Ramdevji, you are asking for the qualification. I'm coming to the qualifications. The assessee has not furnished complete details in respect of amount payable to MSC under section 15 of the Act. Consequently, we are unable to determine and report the particulars required under 22(2) and the 3A of Form 3CD. Because that is the information which has to be provided by the management. Now, 3B, which is required for disallowance, the assessee is responsible for identifying, classifying the suppliers into MSC category and providing a list of trade payables and current liabilities to whom amount is outstanding as on the last day of the financial year, along with the working of the disallowance under 43BH of the Act, required to be reported under clause 22(3)(b), and therefore we are unable to comment on the same. Now, even that also we are saying that it is provided by them and we are unable to comment whether it is perfect. and we'll take all amount of management representation and things like that. So one more change quickly. Let me finish off clause 26 also. Now let us say a particular 43BH, including the MSc, got disallowed in the last year. It should be allowed in this year. So therefore, clause 26 has got changed. Assuming something in assessment year 24-25, last year May 43BH at 15 lakh we had disallowed. We now need to allow that, just like any bonus payment or any GST payment which is disallowed needs to be allowed. So now we will say in respect of any sum referred earlier, it said in clause A, B, C, D, E, F, G of 43B. Now they have included H also. Therefore, they have removed all these clauses and in respect of any sum referred to in section 43B, the liability for which pre-existed on the first day of the previous year, but was not allowed in the assessment of any preceding previous year and was paid during the year. The 15 lakh what was disallowed in 24-25 needs to be allowed. You should put that 15 lakhs here and claim it in your STI, and 143(1)A also will allow. Was incurred during the previous year and for clauses other than clause 43BH was paid. So that is only for 43BH other than H, because 43BH you would have told in the earlier clause number 22. So that is, these are the couple of changes which we need to note. Any questions? Naresh Chandra Garu, how much more time you want me to take?
For the couple of questions, I think in the Q&A.
Sorry, sir, I'm not able to hear you clearly. Sorry. So that is. So I'm very sorry to say that I was not able to hear the question clearly. Is it put in the question and answer box or chat?
Ramdev ji, आपका question not clear, sir.
I think Narendra Garu, you can raise the question.
Yeah, so there are two questions in Q&A. So, are you able to see that the Q&A question, sir? Yes. Are you able to see that?
Yeah, one second. Yeah, I am able to see that. In case there is a donation made from a company for non-business purpose, should this be disclosed in tax audit report since it is being disallowed under? Yes, sir. The answer is yes. CSR as well as any donation which is in the nature of a person. Ramdev ji, आपका mute करना पड़ेगा, please. Yeah. So in case there is a donation, so section 37 says that CSR is not allowed. Any expenditure in the nature of a personal expenditure is not allowed. So donation is considered to be a personal expenditure and hence not meant for the business. And this has to be also disallowed under section 37 and reported accordingly. What are the negative points if we choose presumptive tax method? What are the negative points if you choose presumptive means? The negative point is you shall disclose a minimum profit of 8%, 6% or 50%. That is the negative. The point is, if you don't have that much and still have to disclose under presumptive, that is the greatest negative. So therefore, you may not choose the presumptive taxes. That is from Venkatraman, I think, yeah. Can you explain all the 5 provisos? 1 second. Okay, section 44AB. What are the 5? No, there are no 5 provisos. There are only section 44AB. I mean, he was talking, can you explain all the 5 provisions of section 44AB? 44AB, A, B, C, D, E. And comes proviso. That's what I said. Proviso is applicable only when you're. See, section 44AB says in the case of an entity, you shall do the audit of the financial statements. Audit of the financial statements in the case of a business, if it is more than 1 crore, unless you're covered under presumptive. In the case of a professional, 50 lakhs. And in the case of B, C, D, E, it is in the case of presumptive taxes where you are showing less than the presumptive profits. You shall get it books of accounts audited. So one is for 44 ADA One is for 44 AE and one is for 44 ADA. Now, if you don't come out to the presumptive taxes, you shall get it audited. So, however, it says the proviso says you don't have to do the audit at all if you have already audited and under some other statute. And in that context, you will have to just give the information as stored under the particular form, which is 3CA. So that is how it is stored. Now, broker statement shows same day buying and selling of shares are intraday and hence speculation. Is it correct even though it is opted as delivery during the time of the purchase order? I think this is very, very clear that if you are doing a F&O transaction in a stock exchange, F&O done in a stock exchange, although intraday transactions are speculative, that means you have ordered and you have not taken and you have squared off. So that is considered as speculation. But if you have done a futures and options, although there is no delivery and you have squared it off, anything which is done in a recognized stock exchange, futures and options are not considered to be speculative, but intraday is considered as speculative. Can a partner of a professional firm receiving remuneration less than 50 lakhs or 75 lakhs opt for presumptive tax for his individual return? I mean, I think there was a case law also, I don't remember, but I can share it with you, saying that it is not possible. It is not possible because although there is another point key, if you are coming under presumptive, what are the various expenditure that you have as a partner? Now you have 50 lakh rupees as a remuneration to you. I mean, let us say 40 lakhs rupees remuneration, and you want to call it as I'm a specified professional. I want to claim 50%, that is 50 lakhs to 50%. Ramdeji, let me complete, then you can come on. Up mute kar. So 50 lakh, I'm receiving 40 lakhs rupees as a remuneration. So 50% of that, if I'm showing 20 lakh rupees, I say it is wrong. You will have to actually show the real profit minimum of 50%. I have seen a lot of people showing director sitting fee as a professional fee and claiming 50%, which is wrong. You should actually show the actual profit or the 50%, whichever is higher, as the workout. And there is in fact, there was a case where it was very specifically told a professional cannot claim. This is a tribunal decision, which I will share it with the Mr. Naresh Gilli. For purchase of asset and put to use on or before 410, depreciation is getting calculated for full year in Form 3CD. I don't think that is right. 2nd October is the cutoff date. Can you share the PDF? I will decide. Yeah. I mean, I will share some of it. Yes. Then I am right to say that, am I right to say that MSME disallowance need to be made only when the bill raised by the vendor contains MSME registration? I would say, how would I know that he is an MSC registered entity? Only if the bill says, I think no. You will have to take a confirmation from the vendor whether he is MSC, or what we are doing in all the audit cases is we are taking a confirmation from the vendor that whether he is registered or not registered. When in doubt, we are sending a mail. If he is not responding, then we are sending a mail saying that if you don't respond to us in 15 days, we are considering you as a non-MSC. You are not as an MSC. If a partner A donates to a trust in his individual capacity and cannot do tax audit for that trust, can partner B of the same firm sign the tax audit report? I think what is told is I think, I mean, this is a very, very ethical issue which I'm now talking about. A firm and partner are no different is one view that I will be taking, and I will stand by that. If I have contributed and can my firm sign it through a different partner? The answer is no, is what I would like to say in this particular forum. Is it advisable to do a high-level working based on the head of expenditure for clause 44 disclose and risk incorrect reporting or not mentioned amount in the clause 44? I will deal with that separately. I will tell you what is the thing. The logic mentioned by you for professional and representative. Can you please share? I will share the case law. I will share the case law. Yes. So these are the questions, please. Can I take another 10 minutes, Naresh Galu?
Thank you, sir. Please continue, sir.
Yeah.
Continue, sir.
Yeah.
Please continue, sir.
Sure. So I just wind up with the accounting standards and the disclosures for clause 44. And in case of non-compliance of accounting standard, what is to be told. So I just now mentioned that level 1, level 2, level 3, level 4 is gone for non-corporate entities. ICA has reclassified or revised the criteria for classification of non-corporate entities for applicability of accounting standards from 24-25. So instead of calling it from different levels, they made it very simple. They said large means more than 250 crores. Otherwise you are a micro, small and medium enterprises, less than 250. Now I have further classified it into SME and MSME. This is only my classification. Let me be very clear. Because for small and medium enterprises, the institute has given some additional relaxations. So I have put them into 3 buckets, although the institute has put them only in 2 buckets, which is large and MSME. So large means more than 250 crores of turnover, more than 50 crores of borrowings, or they are not, or they are listed banking, financial institutions, insurance, and holding and subsidiaries of large entities. Then you are large. Micro, small, and medium enterprise means less than 250 crores turnover, less than 50 crores of borrowing, and you are a holding and subsidiary of not a holding and a subsidiary of MSME entity. Now, small and medium enterprise, I have brought in less than 50 crores of turnover, less than 10 crores of borrowings. Please understand, there is a difference between MSME classification for the purpose of 43BH and accounting standards by the institute. For MSC classification of the MSMEDA Act, it is based on turnover and in return on value of plant and machinery, whereas for the purpose of accounting standards, it is not based on WDV of plant and machinery, but it is based on borrowings. So that's a fundamental difference between accounting standards and 43BH and other MSMEDA classifications. Turnover ke liye more than 250 crores, borrowing more than 50 crores, then you become large. And if you are a large, all accounting standards, as told by Mr. Ramdev, 1 to 29, except accounting standard 6, which is withdrawn, I would say, which is depreciated. Accounting standard 6 is on depreciation, which is depreciated and merged with accounting standard 10. And accounting standard 8 on research and development got merged with accounting standard 26. So all 29 minus 2 accounting standards, 27 accounting standards are applicable to an auditor of the non-corporate entity. I have to correct myself. It is not applicable to the non-corporate entity directly. The auditor must ensure that the non-corporate entity follows the accounting standard, failing which in clause 3 of form 3CB, he shall report the non-compliance. Now, when it comes to the small and medium enterprises, when it comes to other than large, let me tell you, if you are a micro, small and medium enterprise, who is a micro, small and medium enterprise? Less than 250 crores turnover, less than 50 crores borrowings. Then you are a micro, small and medium enterprise. You are given full exemption. With respect to AS3, cash flow, AS20, earning per share, AS17, segment reporting, and AS24, discontinuing operations. Now, AS14, I mean, what is written in brown? AS14, amalgamations, 21, consolidation, 23, accounting for investments in consolidation, 25, interim financial statements, and 27, joint ventures, generally will not be there for non-corporate entities. So therefore, you don't have to comply with it. However, if it is there, you shall comply, is what is told by the institute. Then small and medium enterprises. This is, please understand my definition. Small and medium enterprises means if the turnover is less than 50 crores and the borrowing is less than 10 crores, additional exemption is given for such an enterprise with respect to related party transaction. For the first time, my own balance sheet, my turnover is less than 50 crores, and a lot of our own entities turnovers, clients turnovers will be less than, non-corporate entities will be less than 50 crores. For that, related party transaction need not be given, and impairments, AS28 also need not be complied with. Partial exemption on AS15. This is the most important relaxation for non-corporate entities on AS15, which I will talk in detail. AS22, very interesting change has happened for micro, small and medium enterprise. That means anything with less than 250 crores turnover and less than 50 crores borrowing. AS22, that is deferred taxes need not be computed. Only current taxes need to be provided for. And AS28, value in use. For the impairment purpose, value in use allowed to be measured based on reasonable estimate instead of using present value technique. And disclosure relaxations have been given with respect to AS10, fixed assets, or property, plant and equipment now. AS11 forex, AS19 leases, AS26 on intangible assets, AS28 impairment, and 29 on provisions, contingent assets and contingent liability. So let's delve with the AS15. What are the important changes with respect to AS15? So partial relaxations has been permitted for non-corporate entities being a micro, small and medium enterprise with respect to accounting standard 15. Recognition and measurement of liability regarding defined benefit plan for post-employment and other long-term employee benefit. This is the greatest problem for us. One of the biggest challenges for the non-corporate entities is to work out the employee benefit, especially gratuity, because gratuity is a defined benefit plan. Provident fund is no problem. Provident fund is no problem because in the case of Provident fund, it is a defined contribution plan. Whatever you pay gets debited to P&L account. Defined benefit plan is always a problem to the accountant because he has to take the actuarial valuation and do that in a normal entity. How do I calculate actuarial value? How do I calculate gratuity for the purpose of accounting standards 15 for non-corporate entities? For the purpose of a large, I shall do it just like for a corporate entity, but for medium and small enterprises, I have been given relaxation. I don't have to calculate, I take an actuarial valuation for the purpose of calculating gratuity liability. However, because this is a defined benefit plan, I have been given a relaxation with respect to recognition and measurement. However, such entities may account for the accrued liability using some other rational method. That is, method assuming such benefits are payable to all employees at the end of the financial year. That means I will calculate the 15-day salary up for all employees up to 31st of March. Then I don't have to get the actuarial valuation. So recognition and measurement principles, that is PUCM, that is project unit credit method, as laid down in accounting standard 15 in respect of DBP, will not apply to such enterprises. Even the presentation and disclosures have been given a go by. You don't have to give any presentation requirement. Recognition and measurement of short-term accumulated compensated absences, which are non-vesting, need not relaxation has been given 100%. Discount amounts payable after 12 months of balance sheet with respect to defined contribution plan and termination benefit also has been given full relaxation for a non-corporate entity. So this is the format now. The format announced by the institute on the 19th of September saying that it has been deferred by 1 year. So the format for non-corporate entities need not be complied with. So it still is an option. I think Ramdev, you wanted the qualification for accounting standard 10. You are right to say that most of the non-corporate entities will be following the WDV as per Income Tax Act, whereas accounting standard says that you shall follow the useful life approach. You shall follow the useful life approach. So there we have to give a qualification like this: non-compliance with respect to AS10. In the financial statement, the assessee has provided depreciation on property, plant and equipment at the rates prescribed under the Income Tax Act rather than on the basis of the estimated useful life as required under AS10. The assessee has not maintained records of the estimated useful life of the individual PPE. Further, no technical assessment or management estimate of useful life have been made available to us. In the absence of the necessary records and estimates relating to the useful life of PPE, it is impracticable to reliably quantify the impact on the depreciation expenses carrying amount of PPE and the net profit as required by AS10. This, however, does not affect the calculation of the depreciation, return on value, and the ascertainment of total income under the Income Tax Act 1961. So we are saying that it is not followed, but by not following it, because after all we are giving this information in clause 3 of form 3CB, the income tax department should not feel that by not following this, the calculation of tax and the taxable income is wrong. So we are saying that by not following that and by following the return on value of the Income Tax Act, the computation of income tax itself is not being distorted. So the second point is not relevant for this year, but for next year you may, when we have although given this for all those tax audit reports which we have filed before 19th of September, before the institute came out with the relaxation, we have signed and given it like this. The financial statements have not been prepared. Wherever it is not prepared, we have tried to prepare it wherever possible. Please note that although the entity itself is not obligated to prepare, if the entity happens to be a chartered accountant's entity, Ramdevji, look at this. If for your own balance sheet, you cannot say I am not guided by the institute's guidance note. So I have to prepare my own financial statements using the format of the institute. So the financial statements have not been prepared in accordance with the formats prescribed in the guidance note on financial statements of non-corporate entities issued by ICI. While this represents a departure from the recommended presentation and disclosure framework, presentation and disclosure में कुछ फर्क हो सकता है. In our opinion, it does not materially affect the recognition and measurement of income, expense, assets, liabilities, or owner's fund, nor does it impact the ascertainment of total income of the assessee. So this is what we are giving as a qualification. Okay. And then the last one is on the qualification on the clause 44 on the GST. As informed by the assessee, the information required under clause 44 of a form 3CD has not been maintained in the absence of any disclosure requirement thereof under the GST statute. Further, the standard accounting software used by the assessee is not configured to generate reports as required under this clause in absence of any prevailing statutory requirement. Therefore, it is not possible to determine the breakup of the total expenditure of entities registered or not registered under the GST. In view of the above, we are unable to verify and report the desired information in this clause. This is what we are giving in all the cases. So this I think is not required. So I have taken extra time because we started late. I'm prepared to take up as many questions.
Sir, in the Q&A, I think a few questions are there.
Yeah.
रामदेव जी, आप कुछ पूछना चाह रहे थे?
Actually, I didn't wanted to intervene in between.
Yes, sir. No, you can.
But there are certain things which we have noticed. What common mistakes they are committing while reporting. So being it is the forum mainly for Chamber of Commerce, many chartered accountants are also have logged in and they are participating. So I would like to say that this enterprise definition for MSME is defined in Section 2 of MSMED Act, which includes only manufacturers, not traders. Whenever we are asking for the details from the management is simply saying that they are all traders. They are not manufacturers. Whereas the Udayam certificate doesn't specify particularly trader only or MSME.
I will cover this. I will cover that. I got the message. Yeah.
So besides that, any other evidence which we can verify, because it's a very long exercise. It consumes a lot of time. One thing. And second thing, I think in this tax audit report, form 3CD, the question. Hello?
Sir,
shall I continue?
No, your voice is not very, coming out breaking.
3CD.
Yeah. I think you should be closer to the mic, sir. You should be closer to the mic.
MSME Act.
Sorry, sir, we are not able to hear you. I think you are muted also.
अभी बोलिए सर. Muted.
Internet issue, sir. That's why it is continuously. Sir, just one addition to this MSME reporting, sir. This disallowance under section 15. It is muted from Naresh. Am I audible?
Yeah.
Am I audible?
Yes.
Am I audible?
Yes,
Yes, sir. Audible. Yes.
Yeah, then now. Just, Guraj sir.
Yes.
Huh? Audible?
Yes, sir. Yes, sir.
Yes, sir.
Discontinue.
Yes, sir. Yes, sir.
This
We are-
disallowance in 3CD, which is required to be reported for under section 15 of MSMED Act, whether we should include interest, whether claimed or not, shall we compute?
Yeah. So I will talk about these two things, sir. I think three things you have raised. Is there anything else, sir? I think you are now muted, so I presume that these are the three questions. So one is, for the purpose of MSME, are traders covered? Very important, traders are covered for the purpose of MSME only for the limited purpose of priority sector lending in the case of banks. For no other purpose, traders are covered, including for 43BH. So I told you in the creditors list, you remove you remove MSME traders also. MSME traders are also not covered for the purpose of 43BH disallowance, nor for the purpose of section 15 of the interest. Interest also need not be paid to a MSE trader. Now, second question that you asked was classification of MSCs is very, very difficult. So how do I as an auditor look into that? So the auditor has to see how the basis of classification is done by the entity. And if there is a proper mechanism, I will have to still do a test check. Otherwise, I'm afraid I will have to write as an auditor to all the suppliers to find out whether the vendors are small or large. So that is the step. And the last thing is whether the interest again has to be disallowed under 43BH. Our institute also in the guidance note very clearly said what is disallowed once under section 15 of the MSMED Act again need not be disallowed under 43BH of the Income Tax Act. Yep. Yes, Naresh Chandra Galligaru, you want? Yeah, Suhas wants to talk. Yeah, you can unmute and ask, please, Suhas ji.
Sir, no questions, sir. No questions.
No questions. You just wanted to raise your hands. Okay. Expenses of partner. I mean, Krishnan has asked a question in the Q&A box. Expenses of the partner, car maintenance, petrol, car driver, its interest, depreciation, etc. Can not we claim these as expenses? So I would say depreciation of a partner, we are allowing it, we are claiming it in the hands of the partner against the remuneration. But as far as maintenance, petrol, car driver, etc., since it is all borne by the firm, we are not claiming it again. But if it is not claimed, you can claim it even under 44ADA. If you want, you can claim it. That's the point. I would leave it at that. So additionally, does the same logic stand for 44AD? That is, if a proprietor is trading and filing return under 45, can he disclose standard 88% or should he disclose 8% or higher? Yes, definitely. For please understand, any business, 8% is not it is not when we say 8% is the presumptive profit that has to be shown. It is not that 92% is standard deduction. So it is, even in the case of a business, 8% or higher, that should be the amount that should be shown. Is director sitting fee offered under income from profession or income from other sources? So I am showing all my sitting fees as income from other sources, because I am not sitting there as a professional in that sense, but income from other sources. But even if you show under income from profession, it does not really matter. As long as you are computing the right taxes, that is the right thing to happen. And I am showing it under income from other sources because my professional is not, I'm spending most of the time in my profession rather than as a profession in the board. In the case of a CA, if he receives remuneration more than 50 lakhs, is he subject to tax audit? That's what I just now told you. If he is receiving remuneration more than 50 lakhs based on the Bombay High Court decision, you need not be subjecting yourself to tax audit. Can partnership claim depreciation? Yes. Any other questions, sir?
Yeah, welcome, Tansi. So I think all the members have asked various questions, sir. So I think we are also reaching our time. So it was very exhaustive presentation and very detailed discussion as well on various aspects of tax
I
audit.
can only, sorry to intervene, I can only end up by saying that all of the chartered accountants have to ask this question as who is the tax auditor working for? Is he working for the client who is paying the fee, or is he working for the income tax department which has recognized him and made him a sort of a quasi-judicial or a quasi-assessing officer for the department? I mean, I would always say he should work for the department and do the right thing. And in case there are any questions further also, you can write, my mail ID is here, you can write and I will answer the questions. Thank you, sir.
Sir,
Yes.
on this, can I share a one-liner? Your last slide.
Yes, sir. Yes, sir.
Sir, actually, this tax audit report in Form 3CD is nothing but the assessment we are doing.
Exactly. Exactly.
Sir, it is my privilege to propose vote of thanks to Sri Gururaj Acharya Garu. Sir, I am conducting tax audit from 40 years, right from the beginning, 84 onwards. Even then, even now also I am learning new tax. It means 40 years after 40 years also, I have to learn about this tax audit. And one more thing, sir, I appreciate and thank the Direct Tax Committee headed by our Naresh Gali Garu and members of the committee for their valuable contribution in making this important event reality. I am confident that FTCCI will conduct many more beneficial seasons for trade and industry. I appreciate FTCCI Secretariat team for well planning and organizing this meeting. Thank you to Guru Acharya Garu and my members who joined the program, especially Ramdev Bhutraji. He has raised many issues which are not known to me also until now. Thank you, sir.
Thank you, sir.
Thank you, sir. Thank you.
Thank you, Gururaj, sir. Thanks for your time.
Thank you so much. Thanks for inviting me to Telangana virtually.
Thank you.
Right.